Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on as good as gold. So last Monday, the gold market took an unexpected roller coaster ride, resulting in a 3.3% decline against the US dollar, erasing the previous week's gains. Silver, with similar safe haven attributes but a smaller capitalization, saw a more pronounced 9.7% retreat to mid-November levels. All eyes are now on the upcoming FOMC meeting, where surprising developments could significantly amplify gold price volatility. So now let's delve into the recent two-week gold trajectory against the US dollar. Last Monday, spot gold surged over $100, breaking through the resistance zone at $20.75 to $20.78 to a new high of $21.43 per ounce, realizing a 4.6% increase. However, the breakthrough proved to be short-lived. The closing price for the day was $20.29, falling below the 5-day EMA and resulting in a daily decline of 2.07%. The single-day volatility approached 7%, setting a record since September 2020. And on the next day, gold touched the 23.6% Fibonacci retracement level of the upward trend from early October to early December and bid farewell to $2,000 last Friday. The price continued to decline at the beginning of this week, returning to the supply zone around 1982, a position very close to the 38.2% Fibonacci retracement level of the 2-month rally as well. To the downside, the 50-day moving average can be the first support, and the 1930-1940 may come into play. A return to $2,000 may signal a shift from bearish to bullish sentiment. Well, I reckon the recent fluctuations primarily reflect a shift in market sentiment due to thin market conditions. No specific catalyst caused gold to surge to $21.40 or put it back to $2,000. If a reason must be identified, it is thin market conditions and high bid-ask spread. Many sellers quickly exited the market after prices touched the risk or volatility parameters they set, and the subsequent decline was fueled by traders' expectations of an overly aggressive Fed rate cut. Before the reversal, November's liquidity driven by everything market dominated. However, unexpected non-farm payrolls data reduced the Q1 rate cut's probability to under 40%, and the expected rate cut's magnitude for 2024 also fell to around 100 basis points. Compared to other countries, the U.S. economy has resilience, and whether it will proceed with the rate cut as planned is uncertain as well. Now the perceived looseness in financial market is suspect, and the U.S. Treasury yield, influenced by the non-farm payroll report, have shown a slight rebound in this week, boosting the U.S. dollar. Consequently, the opportunity cost of holding gold has increased, diminishing the attractiveness of gold, and the price have naturally declined. Meanwhile, the software's pricing for rate cuts next year has significantly decreased due to the robust performance of the job market, shrinking by 15 basis points compared to a week ago. A more conservative outlook for rate cuts also casts a shadow over the gold prices. And the current market heavily relies on data guidance. If the U.S. economic data softens, it will strengthen market expectations of rate cuts, further propelling gold's prices higher until the rate cuts actually occurs. The FOMC meeting tomorrow is also worth traders' attention, where the dot plot predictions may influence the pricing of the Fed rate cut, and statements and Powell's tone during the press conference may also prompt fluctuations in the US dollar. While in the long term, gold still has the potential for volatile upward movement. Firstly, the uncertainty of global economic and inflation remains, making investors more inclined to hold safe haven assets such as gold. Secondly, although the adjustments of Federal Reserve's monetary policy may bring some volatility, there is currently no signs of a recession that could require a front-loaded rate cut, and the mild nature of the rate cut is expected to mitigate the market's overreaction. And lastly, the geopolitical tension may continue to serve as a long-term driver supporting gold. So that's all for this week. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!